Hello and welcome to the Mutual Fund Show. It's a Diwali special, and which is why you'll hear a lot of clamor in the office, but a lot of happy clamor, if you will, that will happen over the course of the next 30 minutes. But we are going to be talking to two eminent experts about not really what to buy, what to sell, which mutual fund to invest into. We'll tell you about that as well. But the key will be to talk about what is it that these two experts who've been, well, in a manner of speaking, managing mutual funds for donkey's years now, what are their key learnings about the mutual fund industry? All of us, you, me, everybody included, if we've learned one thing over the last 12 months, is not to park your hard-earned money in fixed deposits and bank deposits, but to park the money into assets which can earn us better bang for the buck. And mutual funds is probably that way. Now, what is it that the men who manage your money, who manage my money, and earn us these returns, think about the industry, think about the key learnings that they've had over the last 12 months, probably over the last 12 years, and have to say about this industry and about how the next 12 months to 24 months could be. They need no introduction, but for the sake of it, Mr. Nilesh Shah, Mr. Manish Gunwani, gentlemen, both of you, thank you so much for taking the time out and joining us today on the Mutual Fund Show. It's a Diwali special for us, and it's great having both of you.
Thank you.
Okay, so let me start off with something that we thought we should kickstart this session with, which is what has been the top 2 or 3 learnings that has been for each one of you, that has held true for each one of you over the course of the last 12 months or over for the course of the careers that you've, because both of you guys have spent a better part of your years in the AMC industry. Nilesh, let's start off with you. What would be your key learnings which, being in the mutual fund industry, has taught you about the industry and about the investing and markets?
So I can best describe this by way of one advertisement which I used to see as a kid. And most of us in our generation will remember that legendary advertisement of Hero Honda motorbike.
Okay.
Fill it, shut it, forget it. That's best for mutual fund. You invest, sleep over it, and then let it grow at its own pace. I think in mutual fund industry, the most successful investors are the guys who have forgotten their investments. The guys who invested for a longer term, they have made maximum money. So my only learning from this industry, fill it, shut it, forget it.
Wow, that's so succinctly put. And Manish, that would be true as well, right? I think I remember a conversation that I had with Monish Pabrai, and he was mentioning this about the US mutual fund investors, that the people who made the funds which made the maximum returns had 2 types of investors. One, who had forgotten about their investing, and 2, investors who are dead, and therefore they had no choice but to redeem. I mean, they couldn't redeem their investments.
No, that's true.
Yeah.
In our family as well, what we found is, the shares you bought at IPO or at very low prices, mid-90s. So today when you look at them, 3 digits has become 6 digits, those kind of returns.
Yeah.
So as Nilesh said, obviously, even if you look at the top performing funds, you take 20-year track records, 10-year track records, 18, 20% kind compounding. And if you were to hold them for 10, 15 years, that's incredible rate of return post-tax, right?
Yes.
So that's true.
Yeah, that's true. So what are your top key learnings? I mean, I think we'll have a couple of other questions with Nilesh as well, but if I'm not wrong, in your top 3 learnings out of the mutual fund industry, you were saying that the line that caught my eye was that stock selection is glamorous, but weightage is important and timing is extremely difficult. You want to care to elaborate on this?
So I just want to point out that, look, end of the day, for most mutual funds, because our size is reasonably large, effectively most of our assets are top 300, 350 companies, right? Which is not a very, very wide universe. See, if you're doing personal investing, your universe is much larger. Since you're restricted to, let's say, top 200 companies for 60, 70% of your assets, it's unlikely that at this point of time where the market has matured quite a bit, you will find a totally unhidden gem. I mean, stock selection to that extent is curtailed by that size restriction. But my learning in terms of fund management and running an investment team is how much weight you give to a stock that doesn't get too much press, doesn't get too much publicity. But I've seen a lot of fund managers succeed purely there because they're very good at weighting the stock appropriately, not finding undiscovered gems, which as I said, very restricted universe. But when you have a high conviction bet, when you see a lot of things in favor, you have to go to that front foot and hit it for a six. Sometimes you're very confused. There are times when all fund managers are very confused. And then it's okay, I think, to say that next 3 months, I may not create too much alpha, just hold on, go close to the benchmark. So it's all about how time when you're going to be aggressive, when you're going to be defensive. I think that creates a lot of success as a fund manager if you do that right.
Well, and probably it requires some talent to choose fund managers and mutual fund schemes, which has fund managers betting or allocating high weightage to particular winners. You can't quite know that. So probably track record could be a good way to look at that, or maybe seek an advisor for mutual fund advisor as well. But I think amongst other key learnings, Nilesh, that one thing that stood out for me out of the things that you've given is be a regular investor. I know you said that fill it, shut it, forget it. But one thing that people shouldn't forget is that once you've made an investment, don't let it be the only investment in mutual funds. Be a regular investor, because SIPs can actually go a long way in creating long-term wealth.
So essentially, mutual funds, are a vehicle of investment. And most of us generate regular income.
Yes.
Now, for some Indians, income minus expenses is equal to savings, like the American style. For others, it is income minus savings equal to expenses. Now, that's where the majority of Indians fit in. So we are a nation of great saver.
Yes.
Our savings ratio is in the 30s. But when it comes to investments, we are a nation of lousy investors. We are so stupid and idiotic that we put more money in currency on 8th of November than shares in the demat accounts. The currency notes give 0% return. There's no magic formula where a 2,000 rupee note becomes 4,000 rupee note in your house. It doesn't happen. But still, people put more money in currency notes than in the shares, which were giving 15, 20, 30% compounded return.
Sure.
So we are a nation of lousy investors, and that is where we popularized as mutual fund industry concept of systematic investment. The idea is that markets are markets, they'll be up, they'll be down. If you keep on averaging yourself at regular intervals, over a period of time, the rising tide of India will lift all of us.
Yes.
And that's where we propagate regular investment.
Yeah, of course. And probably that is something that will work for the long term as well. This is turning out to be a fun show, I must admit that. It's actually good to know that. So now the second thing that we thought we should tell investors, and coming from the two of you, would be what would be the top mutual fund related advice that both of you can give to either budding investors or people who are already invested in mutual funds but want to increase allocation. Because there's one thing, Nilesh, that I take heart from. We may be lousy investors, but I think that was probably true 12 months ago. I think we've improved as a lot of investors over the last 12 months in terms of at least people allocating to mutual funds. I can tell you with confidence that the kind of response that we get on the mutual fund show, the questions that we get on the mutual fund show, it shows an increasing awareness about people wanting to invest via the mutual fund route, which is actually very, very heartening.
So, Niraj, there's no doubt that things have improved.
Yes.
But what I wanted to stress was the point of lousy investments where retail ownership of equity shares is less than retail ownership of currency was on 8th of November.
True.
This is the same set of retail investors who allocated 25% of their savings in equity market during 90s bull run, and today are happy allocating 2 to 3% or 4%. So my whole thing is that, look, in our culture, we have been told that don't run after money. Money is not everything in life.
Sure.
In Gujarati, we have been always told, "Paiso hath no mel chhe." I want to tell investors and viewers, money is not everything in life. Money is not important. But make sure that you have made enough money before you make such statement. You need to be wealthy to say that being wealthy is not critical. The second thing which I have seen is that we are all bothered about our physical health. We will go to a doctor whenever there is a trouble. But we are not bothered about our financial health.
True.
We need to have a family financial advisor. An advisor who can give shoulder to us, who can give advice to us, one who can manage our emotional balance between greed and fear. So it's important to realize the value of money. It's important to have a family financial advisor. And third, and the most important thing, is to know that making money looks very, very simple. Buy a good stock, stay longer term, you will make money. Do SIP, you will make money. But when you have to execute it on the ground, it becomes very, very difficult.
True.
So don't just take these things at face value. Thinking is just one part. Execution is 99% of the job.
Yeah, that's true. And that's where I think, Manish, I want your advice as well. So you and me are having a good time having fun at Nilesh's comments. But your top mutual fund advice is stick to asset allocation from a long-term perspective. You care to elaborate a bit on that?
So what I think tends to happen at what Nilesh kind of referred to. See, when the market is rising, today, while the Nifty hasn't done much, but a lot of mid-cap funds, flexi-cap funds, good solid returns, 3-5 years. And then we see a lot of money coming in. Unfortunately, the moment market weakness comes, the money goes out.
Yeah.
So I think what is critical is, first you have to establish the fact that at least historically, nothing has given as great a return as equity mutual fund, right? I mean, 18-20%, very liquid, very easy to transact, post-tax, is a phenomenal return. So once you establish how much you want to be in equity, let's say you have 100 rupees, you want to be 40 rupees, then I think investors should not get swayed by extreme years, whether 92, 94, 2013, 2017. You have to act a bit contra if at all, but even if you don't act contra, you at least be disciplined about it and keep going at it for 10-15 years. Some great stocks, even if you bought in 2007 and you held till today, at the peak, but you still made 20-25% CAGR. But you have to be consistent across years in terms of investing that amount of money which you've allocated to equities. It's easy to be swung by fear and greed, but somehow they need to be able to keep that disciplined approach to invest. I think that's more critical than worrying about the last decimal place return of a fund versus the other fund, I think.
Yeah, and I think viewers, we typically underestimate the importance of this compounded annual growth rate over a period of time. 10 years of 20% CAGR returns would make you substantially wealthy, as opposed to being greedy enough for a 50% move on 1 year and then kind of having a bit of a lull. So just be mindful of that fact as well. But speaking of returns that have been made, I think Jayesh Khilnani has some very interesting data on what's happened over the last 12 months, what have different schemes done, what have different stocks within schemes done, and lots more. So let me give it across to Jayesh to give us some very, very interesting data about how mutual funds and the industry is shaped up over the last 12 months. Jayesh?
Niraj, first and foremost, wishing all our viewers a very happy Diwali and a prosperous new year to come. And now looking at the data that we have on the screen, I did a compilation of all the Indian listed mutual funds, that is the equity mutual funds, from last Samvat to this Samvat. And I have filtered out the ones which are, focused more towards the broader market and removed the ones which are, thematic based, which gives you a very skewed result. So let's have a look at which are the funds that have actually outperformed the indices. Now remember, Nifty, Mid Cap Index and the Small Cap Index have given you returns of in the range of 18 to 25% each. And these all funds have in fact significantly outperformed these benchmark indices. So the first one that tops the list is IDFC Focus, which has given you a return of as much as 36%. Now the key over here is that they invest in a maximum of 30 companies. The SBI Small and Mid Cap Fund that in fact focuses more on the small cap stocks that are available and has generated return of 32%, followed by IDFC Sterling, which again, it follows an investment philosophy of investing into the CNX mid cap companies that are listed on the index. Moving on, the fourth one we have L&T Mid Cap, which has a very unique investment strategy. They invest in companies which are in the market cap range of 300 crores to 3,000 crores. So that has given you return of 31%. And the other one, last one, is Birla Sun Life, which has given you return of 30%, which is the only diversified fund that we have on this list. Niraj, a few takeaways that I can think of from this data is that Indian mutual fund managers have been able to generate alpha over and above what the index has provided. And the other one is that, mind you, that this is point-to-point return. The concept that you are discussing in the studio of SIP, had you done that, then the returns on these, the numbers that you look on the screen would have been significantly higher.
Yep. Yeah, thanks a lot for that, Jayesh. Remember, while this is more a depiction of what funds would have done over the year, it is in complete contrast to the message that we've been giving by the mutual fund show, that don't just look at what a scheme has done over the last 12 months or the last 24 months or the last 36 months to determine which scheme you should invest into for the future. Please consult advisors, because what your needs are for your particular portfolio could be significantly different than what each of these schemes would have been doing. But the idea of doing this is to just show to investors that mutual funds and apt schemes have actually outperformed the benchmarks in a significant way, and the benchmarks themselves have really done much, much better than what fixed deposits or bank deposits have done over the last 12 odd months. Now, since we're talking about returns, Nilesh, let's start off this conversation with you. I know it's difficult to probably preempt what the returns that equity markets could give you. But to your best guess, people have looked at the last 12 months, last summer to this summer, and looked at what, 16, 17 odd % returns. The numbers may vary here and there, but 16, 17% returns. To your mind, what's the quantum of returns that an average investor should expect by investing in an average mutual fund?
So, average equity mutual fund will be able to give the return which can meet your need.
Okay.
But it will never be able to meet your greed. So mutual funds are for meeting your needs, not for your greed.
Okay.
The most important thing which an investor must realize is that fund return and investor returns are not equal. Globally, it has been proven that in most markets, investor returns are significantly lower than the fund return. People do rear view mirror driving in investing rather than front view driving. Now, let me explain. There is a fund which falls from 10 rupee to 8 rupees. It's down 20%.
You're about the NAV.
NAV. Another fund goes from 10 to 2. It's 80% down. So in the year one, fund A looks better because it's only 20% down versus fund B, which is 80% down. In the year two, that 8 rupee becomes 10 rupees, so it's only 25% return. And there's a dead cat bounce in second fund, which becomes 2 rupees to 4 rupees. It's 100% return. Now, a lot of people will end up investing in fund B based on 1 year performance because it's 4 times better than someone else. But the good advisor will actually recommend you to invest in fund A because that fund manager has moved through the turmoil to deliver safety of principal. So when you are investing in mutual fund, don't bother about fund return, bother about your return. Don't look at past performance, look at future potential.
True.
And this is looking very simple. I just have to listen to a show like this. I have to follow an advice like Nilesh or Manish. I can go to a website and find out 5 top mutual funds. That's not going to work. What is going to work is building a portfolio which meets your investment objectives. What is going to work is this longer term investment horizon. What is going to work is this regular investment. What is going to work is what Manish mentioned, asset allocation, equilibrium between greed and fear. If making money was so easy, every viewer would have become billionaire.
True.
please realize that it's not that easy, and hence you need an advisor who can construct right portfolio through right tools to achieve your objective. As I mentioned, mutual funds can meet your needs. Great, try something else.
Yeah, try something else. But I must tell you, with whatever little experience that I have, is that trying something else may also not work. Quite frankly, for an average retail investor, looking at all the options that are available over the last 12 or 15 odd years that I've been in this business journalism industry, probably mutual funds it is. For a lot of people, Manish, who are still wanting to get a gauge of what's the quantum of returns that an average mutual fund investing could give. Maybe not necessarily over the next 1 year, but say over the course of the next 5 years. Somebody wants to make an investment, fill it, shut it, and forget it
yeah.
for 5 years or for 10 years. What's an average expectation that one can have? I mean, numbers may vary, but yeah,
my
still.
best guess is typically an average mutual fund would probably be close to the benchmark. The issue is on a, let's say, 8-10 year basis, what can the benchmark do? Again, no one can predict the future, but my guess is it'll be slightly less than last 10 years, purely from the fact that I think both globally, because of debt and demographics and all that, and in India because of policy, we're moving to a slightly lower inflation trajectory structurally. So a lot of growth obviously was driven by inflation in terms of nominal terms over the last 10 years. So if I were to take very roughly an average GDP growth of 6 plus 4% inflation, we probably do nominal 10-11% versus maybe 12 to 14 what we've been doing. And I guess corporate profit on a conservative basis, let's say nominal GDP, although I have a feeling it could be a bit higher, because also I think what is structurally happening is a bigger and bigger part of economic activity is getting formalized. So the organized guys should outperform nominal GDP is my guess, but maybe on a conservative basis, typically 12-13% corporate profits. And on a 10-year basis, starting point of valuations relatively don't matter, because the compounding of earning is so strong that whether 18p becomes 16p, it's not going to materially change the calculation. Right. So my guess is slightly less than last 10 years, somewhere in the 10 to 13% range.
And that's not bad. I mean, I just want to get, I want to tell viewers that 10-13% returns over a 10-year period is not bad, right?
Post-tax, opportunity cost being lower next 10 years versus last 10 years, because last 10 years FDs gave higher returns, I would think, than the next 10 years. I do think 10 to 13 is a great return.
Yeah, Nilesh, what about you? I mean, people would just believe that, in stocks people earn 50%, 100%, 10 to 13% return. How good will that be? Over a 10-year period, that's a staggering number.
So my question is very simple. Do you think Sachin Tendulkar is the greatest batsman in the world cricket? 99% people will say yes, 1% will not agree to it.
Yeah, there will be some Virat Kohli fans maybe.
No, there will be someone who will appreciate someone else, which is okay.
Which is okay, yeah.
And that 1% guy probably will come back saying that Sachin Tendulkar was so gifted, so talented, so committed, and he faced 30,000 balls, so ideally he should have scored 180,000 runs. Because if with his talent he couldn't hit 6 every ball, then he's not the greatest cricketer. Now the reality is that Sachin Tendulkar became Sachin Tendulkar by not hitting every ball for a 6. In fact, out of 30,000 balls, he scored only 15,000 runs, but yet he's the world's best cricketer. So in the stock market, you can't hit every ball for a 6. What is important is to stay on the pitch.
Right.
Imagine if Tendulkar had tried to please that 1% lobby, trying to hit every ball for a 6, he would not have become Tendulkar, he would have become something else.
Yeah.
So it is time on the pitch which made Sachin Tendulkar. And for an average person, average stock market investor, he must realize that neither he has luck of Tendulkar, nor he has talent of Tendulkar, nor he has commitment of Tendulkar, nor he has discipline of Tendulkar, and yet he wants to hit every ball for a 6. what can we offer other than prayer to him?
Well, yeah, that's true. Maybe a Sachin Tendulkar would have become a Niraj Shah. I never managed to score a century during my entire school or college days. So therefore became a bowler. Was a decent bowler, but never quite became a good batsman. Anyways, I think one thing that people would want to know over the course, and I repeat this, I'm loving this show today for whatever reason, but one thing that people would want to know, what to do with their Diwali bonus. I mean, for a lot of people, they would say, hey, we're not getting a bonus. It's not been a great year. But there are a few people who are getting that lump sum amount, or who, for whatever reason, have some lump sum amount with themselves in the bank. How should they make investing in mutual funds? Because the common example, and one really quirky thing that I've seen, I don't know, maybe you guys have seen this more, is that people know what is an SIP. People don't quite know how to go ahead and invest in a mutual fund. It's a very strange thing, but it is happening, and we get these queries on our show as well. So the idea is for people who have a lump sum amount, but they can't start an SIP with it, or maybe they can, but what would your advice be? How does one invest a lump sum amount? How does one invest a Diwali bonus or a year-end bonus that is one to get? Manish, let's start with you.
My view, and in a sense I'm repeating what I said, is just fix your long-term goals of how much wealth you want to try and create, what are your end goals, whether it's retirement, child education, whatever. And I don't think they should change it based on what's happened last 1 year, or last 3 years. So if some mid-cap funds have done phenomenally well, it should not be you go put 100% of your bonus into those funds. I'm just saying, keep your goals in mind. If you've decided 40% equity for 10 years, just remain at that 40%. If you've decided out of that 40%, 20% large cap, stay in large cap. Whatever you've decided.
What if somebody hasn't decided?
I think then they need to. I mean,
so seek a financial advisor.
Definitely. I think what Nilesh said is absolutely true, that even amongst our own community, we see so many people slogging late into the night, but they wouldn't, do the basic stuff to create wealth.
Right.
It's real tragedy, actually.
Okay, so that's the advice from Manish Gunwani. Nilesh, what about you? For somebody who has the money right now, wants to invest, wants to know how to go about doing it, even if he wants to do it in the mutual fund route.
So my selfish interest suggests him that go and invest in Kotak mutual fund.
That's not a bad decision.
The best way. So one, your Diwali bonus is not the only thing to invest. You earn salaries and hence you get bonus. So you have to first figure out what are you going to do with the salaries which are going to receive from tomorrow onwards.
Right.
So let bonus be part of this pool, including salary money, which you are going to invest. Second, have a financial advisor which can recommend a plan for you. Are you investing for your marriage, which is likely to happen in next 1 year? Are you investing for your retirement, which is likely to happen after 30 years or 40 years? So please have a plan and then proceed on it. And don't consider Diwali bonus as the only thing to invest. You are getting bonus because you are also getting salaries. And please remember, income minus savings is equal to expenses, not income minus expenses equal to savings.
Okay, that's important advice. Maybe that you preempted my last question. What I wanted to end the show with is that one thing. I know you gave your learnings as to what's happened via your tenure in the mutual fund industry. But I know that equity markets, mutual funds or direct equity investing does teach us something about investing and about life per se as well. At least I'm sure to me it has, I'm sure to you as well. Last 1 year of equity market investing, if it's taught you something, one thing that it has taught you. Nilesh, let's start with you and then I'll go to Manish.
So the last 12 months of equity markets have shown us the power of hope as well as liquidity. We have seen in the past when liquidity came with greed, what catastrophe it created in the market. And now we are probably seeing liquidity coming with hope and what kind of positive impact it can make on an economy. So I'm trying to figure out, based on last 12 months experience, is this liquidity with greed or is this liquidity with hope? On this Diwali day, I hope, pray and believe that this is liquidity with hope.
Yeah, all of us do, quite frankly, and hopefully there are figures and the economy and the earnings numbers which live up to that hype as well, Nilesh. cross fingers for all of that. Manish, to you, your top learnings over the last 12 months.
I think it just taught me to expect the unexpected, because you can get the economy going one direction, the market going the other direction. Been very surprising, to be honest. But I just think that it all boils down to, as I said, just maintaining your long-term discipline rather than trying to time things. It's markets always surprising you, and I guess that's true in life as well today.
True.
So,
But both of you will be bullish on markets over the next 12 odd months. It's a difficult call maybe, but maybe you can share one last thought on that.
So my view is the business cycle, both global and domestic, is at the bottom. So the valuations are a bit of a concern, but the fact that we are not at IIP of 10, credit growth of 20%, to me that's good enough. So I do think that over 3 years you will get a decent return.
Okay.
In my 25-year careers, I haven't seen one day where I was bearish. I've always remained bullish. And I want to end this with one, particular event. This was somewhere in, second half of 2008, post-Lehman crisis. Markets were at 8,000. There were 5 of us in one of such kind of event. And I don't want to name the person, but there were 5 stock market participants, brokers, fund managers, proprietary investors, who were trying to be bullish on that day. And we had seen index dropping from 21,000 to 8,000. And there was one person who was going gung-ho, saying that 8,000 will become 6,000. By the God's grace, till today, that person has not become right. That was the absolute bottom of the market. And now even that person was, resoundingly saying that 8,000 will become 6,000, wouldn't say that. So in 25 years of my career, I haven't had a day where I needed to be bearish. I'm bullish because we believe India is changing. It's a trend where it doesn't mean that there will be no volatility, there will be no correction. Of course, markets are cyclical. By nature, they will go up and down. But I believe in this country, our time has come, and you need to be bullish. You need to be optimistic.
Well, if you needed to end on a more positive note, you couldn't have found one. But Manish Gunwani,
thank you.
Nilesh Shah, gentlemen, thank you so much for taking the time out and joining us on the Mutual Fund Show. And we sincerely hope, that's the endeavor via this show as well, quite frankly, to get more and more Indians invested via the mutual fund route. I must end with one small patriotic note that I've been accused of over the last 3 or 4 odd days. That 6 years ago or 7 years ago, whenever we used to talk about marquee Indian stocks, they used to be predominantly owned by FIIs. It's a very heartening scenario to see Indians owning a lot of these marquee names, albeit in a small way, but it's picking up. And I personally feel very, very happy about that. Maybe it's thanks, in a large part, to the mutual fund industry as well. Thank you so much, gentlemen, for joining in today and giving us your thoughts, and wish you and your team a very happy Diwali and a prosperous New Year.
Happy Diwali,
Happy
to you
Diwali
and
to
your
everyone.
viewers.
Okay, viewers, and thank you so much for tuning in. Same time next Wednesday, the Mutual Fund Show.